Hey, FreightWaves fans and friends, ladies and gentlemen and neighbors, thanks for tuning in today on Wednesday, the biggest day in the cyclical cycle of the trucking weekly index, for lack of a better word. But we are excited to have you here. Partly because, we have a lot of usual suspects that come on as our market experts. Well, today we have a couple of unusual suspects. Daniel Pickett coming live to us. He, the chief data science nerd, is going to give us like a whole overview of DAT Van Rates and why there's a need to look at them in certain regions rather than just looking at them nationally. And also our chief economic nerd, Ibrahiim Bayaan, is going to tell us, give us an overview. Macro, micro, what are we looking at? Well, that's a tease. Stay tuned. In the meantime, always here to tell us the bad news is none other than Nick Austin. Tell us what is happening today in disruptive conditions, Nick.
Bad news out in California again. And we're not just talking about snow, Chad. But let's talk about that first, because that always gives truckers more problems than rain.
Yes.
In most cases. So the Sierras out in California, you see all the blue on the map right here. There's even some green in some parts of the Sierras. Here's what's happening. Yes, a lot of heavy snow in the Sierras, which have gotten a lot of snow this winter compared to last season.
It seems like almost every other day.
Yeah, it's been hard for them to catch a break lately. But yes, we're talking about some of the typical trouble spots like Carson Pass and Donner Pass and some of those areas. We'll see several more feet of snow from today on through the day tomorrow. So that's going to cause problems, especially trying to get through the Reno area too. Problems on Interstate 80. There probably will be sections of that interstate closed once again. Might end up getting turned around. And the thing is, the snow levels are going to keep kind of going up and down.
Are they?
Just because of warmer and colder air coming into the system. So some of the foothills of the Sierras, some of the lower slopes may start out as snow, but then it'll change to rain and then go back to snow. So that'll make for a sloppy mess. That's not going to be any fun out there.
Have you been, and I don't mean to put you on the spot, I don't know if you know, but have you heard any reports of how truckers have been dealing with those conditions over the past few days and weeks?
Only from what I've seen on social media. Almost really through a lot of the snowstorms that they've had out there this season, I've always seen either pictures or videos of either trucks just stuck off of the sides of the highway, including Interstate 80. They're just sitting there because law enforcement has
shut things down
the areas off and shut some sections of the highway down, and then everyone gets turned around and are told to go back because they're not letting anybody through. That has happened several times. Matter of fact, last weekend, I believe it was last weekend they had, or the weekend before last, they had a big storm, and a section of I-80 from the Reno and Carson City area on into the Sierras was closed for more than 24 hours. So
that's a long time.
That's a long time. And there's not as much volume, of course, on the weekends, but this storm is coming during typically the busiest days of the week for truckers, which are Tuesday, Wednesday, and Thursday. So, and this is just going to go on and off throughout the week, just all these periods of heavy snow. So, but the coastal areas, like from San Francisco and possibly even in parts of LA and San Diego, it's heavy rain. There could be flooding in some of the valleys and the mountain areas too, as well as right in San Francisco and some of the other major cities. So that's going to cause problems on Interstate 5. Also, snow on I-5 north of Redding, which is up in towards Northern California. Not far from the Sierras. That's going to cause problems as well. And we notice right now, this is the head haul index that we have up on the map. So the Stockton market right here, which you can kind of see behind the radar, is in red. That includes a good chunk of the Sierras. That means there's a lot more inbound volume than outbound. So there are a lot of trucks there, but it's going to be hard to get them out. Because of all the snow, and then there's also all the rain as you head towards the coastal area. So
seems brutal
lots
out
of
there.
Messy weather.
On the left coast. Yeah.
Now there is going to be snow in other spots too. Maybe you're about to ask that or thinking about that. You know, snow.
Well, I see it right there on the map. Yeah.
Not as big a problem, but just snow scattered across parts of the Rockies, Cascades today, and parts of the Northeast. Not as major problem for those areas. I mean, they're used to that. These aren't major storms. But I did just want to mention that.
Thank you.
So
awesome.
So we're going to be keeping an eye on the Sierras. That's going to be a problem, I think, for the rest of the week, not just today.
Okay. Well, thanks for the bad news as usual, Nick. Right. And you know, just much like the show must go on, the freight movement must go on. So stay safe out there, and you know, keep trying to push on through if you have to be out there. And now, bringing to you a special guest we have on from time to time, responsible for so many of the hundreds of indexes that we have on our original sourcing of sonar data. Daniel Pickett, hello, Chief Data Science Nerd.
Hey, thanks for having me on FreightWaves Now again after so many weeks. What I want to talk about today is really the DAT Van Freight Index, which is, I know everybody's heard about the futures trading network that is coming.
Yes.
There's a map of the futures lanes right behind Chad here.
Right.
If you catch this, you can see which lanes
here are the major lanes
are going to be traded. Those were selected because they have high correlation to all the other lanes in the United States. So it enables people that are, you know, truckers that are dense on certain lanes, shippers that have production facilities exposed nearby to really get an effective hedge. And so that's sort of the color or theme of what we're talking about. So what you see up here is the West Van corridor. That's the white line. The West Van is simply an average of the LA to Dallas, I'm sorry, the LA to Seattle, and the Seattle back to LA. So it's kind of that
so the white line I see is an average of these two. It's simply an
average of those two.
Interesting, that's different.
And they are weighted equally, even though there is a lot more traffic going from LA to Seattle than there is going from Seattle to LA.
Yeah.
That changes over time, and for a specific shipper, their volumes won't necessarily match the broad freight patterns. So their way to deal with changes in volume is really to go long more miles or go short more miles in specific months where they know they're going to have exposure, rather than having a volume weighted index, which is going to kind of move unpredictably or maybe differently than their particular patterns.
Gotcha. So make it a lot more going from LA to Seattle as one would expect.
Yeah, not surprising. And like the map Nick showed earlier, head haul versus back haul.
Right. And then coming from, Seattle.
Right. Seattle, a fairly famous back haul that gets a little better, at the beginning of the year, at Christmas tree and apple season.
And how do these compare to, like, say, a national average? And is this why you're showing us these regions?
Sure. Yeah. So this is the West region.
Okay.
Next, I think we have the South region, which this is LA to Dallas, Dallas back to LA, and so South US Van is that southern lane.
And again, the average between the two.
Correct.
We don't usually do it this way. That's cool.
Correct. And there are reasons why it is a arithmetic average, not a volume weighted average, and that really comes down to hedging your specific risks and kind of the volume you will have at each month of settlement. So that's South. Again, it's an average. And then finally, the East Coast, that triangle of Atlanta to Philly, Philly to Chicago, Chicago back to Atlanta. And you see something similar here where each lane is kind of moving according to its own seasonality. There is a basket if you were a really dense East Coast, chain that, or has more customers.
You're taking our three main lanes for that triangle that we just showed, and the white is the average of those.
And the white is the average of those three. And then there is a national basket, and that's going to be more used by people that have national distribution. So brands that are available in every store, no matter what state you're in. This may make a lot more sense for them.
And tell us about what these different...
Sure. So the national index that futures will be traded on is an average of those three. Right now, that's $1.35 a mile. Now, we've seen a lot of reports out on social media from some of the other pricing vendors that say it's about $1.90. And on a volume-weighted average, the lanes that are having high density, the rates, high volumes of loads, the rates tend to go up because there's more demand for more loads there. But when you do this arithmetic average, which is more in line with how futures are going to trade, that's why you see that gap. And We heard it. We heard it on social media. We heard it even within our office. We had questions from customers on.
Okay, well,
why are you telling us 135 and others are telling us?
Well, and you are a chief data science nerd, so this stuff sounds sounds easy to you. But so can you explain in somewhat maybe a little more layman's terms, like, well, why would people be weighting it in a volume way, and what's the difference here in what we're calling the arithmetic average?
Yeah. So, I mean, let's say that I am a manufacturer of those little plastic orange pumpkin, candy baskets.
Sure.
I'm going to have all my volume at one time a year. So I care very, very much about the rates in those days leading up to October.
Oh.
I don't care so much about what rates are doing far away from my production facilities or in months when I'm not moving a lot of volume. Now, this is a very, very simplistic example. But it's really important to pay attention to, you want to think about hedging risks that are specific to your carrier, your brokerage, or your production company that's shipping goods out to consignees.
Your lane,
your time of year where your heavy volume occurs. And so that's why you see very much a focus on letting people select the exact lane and the exact month of year where they're going to see heavy volumes to kind of offset the risks in their business.
Okay, wow, that is a big overview. Looking at it, thanks for that. That's awesome, Pickett.
Yeah,
appreciate that. And we are on the road with the Freight Futures road show tour. Was in Houston yesterday, headed to Dallas for Thursday. So check it out. You can check it out on FreightWaves.com. You can live stream these events if you aren't one of the lucky few who get a ticket to the original show. Okay, and now we are visited by Chief Economics Nerd Ibrahiim Bayaan. Hey, welcome back.
Hey Chad, how's it going?
Great. So what do you got up your sleeve for us today?
Well, it's an interesting time to be an economist. I mean, we're still kind of catching up from the government shutdown. A lot of these statistical agencies weren't operating while the government was shut down. And so we're kind of getting some of this data back up and flowing. And so a lot of the data that we're looking at sometimes is a little bit older as the Census Bureau and the Bureau of Economic Analysis kind of catch up.
Yep, last time you were on, you were telling us all the things that you couldn't tell us.
Well, so the last time I focused a little bit about like what do you do in these situations where you don't have data at all, right? And we talked about some of the things that we collect in Sonar that'll speak to things
private
that are
sources,
going on in the economy. But what I wanted to talk about today was some of the data that we now have trickling in. Now, generally speaking, old data isn't terribly interesting because by the time you're looking at it, it's already kind of ancient history.
Okay, and that is what this is. I don't think we've ever pulled up the goods imports year-over-year change.
Yeah.
Can you tell us briefly what that is?
So it's just a measure that the government collects of how many goods are flowing into the United States from other countries.
Just overall,
yes.
Whatever it may be.
This is just a total number here.
Maritime, air cargo, anything.
Yeah.
Okay, gotcha.
And normally I'd be like, well, November data, whatever. But some pretty interesting things happening within the trade sector right now.
Yeah.
Trade policy has been on the forefront of everybody's mind for about a year now. I mean, it was around this time last year that President Trump had the initial announcement for tariffs on steel and aluminum, which was late last February. And so there's been a lot of question as to what this is doing to import volumes. And so if you take a look at the chart here, right? I mean, again,
right on that 3.4. This is the app. Tell us about what this means.
So this is year-over-year growth rates here.
Yeah.
And the one thing I wanted to point out was that really through most of 2018, import volume stayed pretty strong. I mean, there were announcements about tariffs, retaliatory tariffs from other countries on U.S. goods. But through all of that, import volume stayed pretty strong. And so people were wondering, sort of, what's going on here with imports? Why are they so strong? Even though we now have tariffs where we didn't have them before. And a lot of most people kind of had this gut feeling that what companies were doing, they were bringing in more now because they were worried that the trade situation was going to get even worse.
Trying to get ahead of it, yeah.
Right, and so, especially as it relates to China, because I think things escalated between the United States and China more than it did through the rest of the world.
Does that remain your theory, your thesis? Okay.
Sure, and I think the data is starting to back that kind of thesis up. If you look through the third quarter of this year, I mean, import growth was double digits, right, over 10%. throughout the middle part of the year, all the way through the third quarter. But then when you look at the fourth quarter, you see this slowdown in import volume.
Definitely the slowdown. Yet, I guess if we're gonna, spin it in a positive way, and appropriately so, is that it's still so high, relatively speaking, right?
I'd say it's positive. So we're definitely not in 2016.
Right. It
areas
trended
yet.
way up.
Yeah. But it's still significantly slower than what we would have seen before.
Sure.
And if you look at like the month-over-month change instead of year-over-year change, it actually declined. Like imports declined towards the end of last year.
Okay.
And so this again goes to this idea that there was a lot of pre-importing that went on, and at some point companies are just like, okay, we've got enough in, and so you get a bit of payback as you get towards the end of the year, and so you get this slowdown in trade growth. Coming from very strong levels of growth. And so when you're looking at like the overall freight markets and how that kind of plays out, this is one of the things that we've been concerned about in terms of like what's going to drive freight demand going forward. If you think that like a lot of the activity over last year was just this pre-importing and that at some point it's going to stop, what that basically means is that there's going to be a source of freight demand that's not going to be there, that was there over the previous several quarters.
Okay, well, we will stay tuned. I know you've got a couple of other slides up your sleeve, giving us a broader overview. What else is this?
So this here is the business inventory to sales ratio. So this looks at companies' inventories as it relates to the number of sales that they have. So the higher the inventory to sales ratio, the more companies are keeping on hand to meet available demand. And there's been a general trend downward trend in inventories. Companies have been keeping fairly lean inventories over the past couple of years. You can see, there's sort of a peak here in 2016. Part of that is because sales weren't that great. But then you get this gradually drifting down trend in inventories up until the middle part of last year, right? And that's
where the data ends.
Well, it ends towards the end. This runs through November, I believe.
I see. Okay.
But or October, November.
Yep.
But yeah, so what I wanted to bring out is there's been like a bit of a reversal over the past couple of months, that instead of this downward trend, you're starting to see inventories build back up. And so this goes back to this idea of what we saw with imports, that a lot of companies were bringing in imports from the rest of the world.
Very interesting.
Just ahead of time. And they were just kind of storing it in their inventories.
And this almost goes up as things might get worse, sort of. It's like...
Well, so this can go up for a couple of reasons. One is things get worse. If sales go down, the denominator falls down here, and that'll push it up, which I think is part of what happened here. But it can also go up if companies are just storing more inventories on hand. Now, sometimes that happens because they're anticipating more sales in the future.
Yes.
Sometimes it happens for reasons like I think is what's happening here. It's just trying to getting ahead of any worsening of tariffs that might be there.
I see. Okay, interesting stuff to keep our eye on.
So we actually saw some of this in our own data. It takes a long time for the government to see some of this data, but we saw a similar sort of run up in our data when you look towards the end of last year. Now this is sort of some of West Coast performance here. This is the Los Angeles market.
Right. So we're looking at a more common, index that our viewers may be more familiar with. The what we call the OTV. It's about volumes. And then you're cross comparing it with the tender rejections, both out of LA, one of the biggest ports.
Right.
And what are we seeing here?
Well, a couple of things. Again, I think a lot of the tension around trade revolves around this U.S. to China relationship.
Yes.
And so this is why we pay closer attention to what's going on in the West Coast than say what we might see on some of the East Coast ports. But I wanted to point back to this November area, where you could see the similar kind of surge in volume coming out of LA. Before you get a dive down.
And then interestingly, it was correlating with tender rejections.
Well,
maybe because of tight capacity.
Normally what happens is you'll see the volume kind of spike up, and then the rejections will follow pretty close afterwards.
But now what we're bringing to light is this gigantic disparity.
Sure. So this is just sort of
volume really growing.
Right. It speaks to the amount of capacity that's being added into the LA sort of the West Coast.
And that plenty of capacity, even while volumes are rising.
Yep.
Okay. Awesome. That's really interesting.
One last thing before we kind of get out. I just wanted to take a look at the export side.
It's kind of the opposite
right?
of the very first one you showed us.
Before we talked a bit about imports. This just shows year-over-year change in good exports. So this is all the goods that are flowing out of the U.S. A similar sort of thing happened on the export side. You saw this run up in export growth, and then you saw some payback going afterwards, where the growth rate just gradually sort of declined, which is in part payback for the earlier spike that you have here. Now, from an overall kind of economic growth standpoint, if you have imports dropping and exports dropping at the same, it really doesn't make a huge difference to the overall GDP numbers. I mean, GDP is concerned about what domestic production looks like, but from a freight perspective, it makes a pretty big difference. Like it's one thing to have, say, 2.5% GDP growth with a lot of trade, and it's another thing to have 2.5% growth with almost no trade at all, or slowing down trade. Because it means there's less movements in and out of the ports, which drives freight volume. And so it's one of the things that we're concerned about, that even if the economy doesn't necessarily slow down, doesn't necessarily fall into a recession or anything like that, or even slow down way below trend. Like, I still think overall growth is going to be above trend in the economy, but we are worried about some of these things that tie to freight volume performance and freight demand, and the slowdown there. We've seen the slowdown in exports already, starting to creep over into the import side, which just means less demand for movements.
Wow. I feel so educated. We have, like, this is what we do for you, whether or not we bring you these kind of particulars each and every day. Each and every day, we are taking a little bit of a look at some of our indexes and the original sourcing that we are able to have, and we have market experts perform, an analysis trying to help us and you be able to keep, a weather eye on, possible disruptions and possible possible opportunities, and knowing where you may be getting a good deal or a not so good deal. So on your rates. So thanks to everybody who is a part of today's production, especially the wonderful Wizard of Croz driving that train for us on those multiple indexes and organizing everything such as he is. So we are and thank you, Lexi, for the film work. Hey. Tune in every single day, would you? We love to see you at 4 o'clock each and every day. Check us out on FreightWaves.com and on Twitter. Share the love, and don't worry, be happy.